Hi there, today we have an exciting video about building a successful stock portfolio for achieving our financial goals. We will run through what strategies are out there for building a portfolio, and then we will look at my portfolio allocations. Afterwards, we will look at why I prefer picking stocks instead of buying ETFs, and what are my selection criteria for picking those stocks. And finally, we will wrap up and conclude. Before we start, I must say that I'm not a financial advisor and this video is not financial advice. Please do your own due diligence before investing in anything. First, and perhaps the most important thing to do is to understand what is that you want to achieve. Why do you invest and what do you expect from your portfolio? The portfolio is the instrument that will get to your financial goal, but you need to steer it in the right direction along the way. So, whether it's a house of your dreams that you want, a car of your dreams, financial freedom, or whatever else, be clear about what your goal is. And also identify a fair time horizon. Is it a 5 years investment, 10 years, a lifetime? Having a clear time horizon is important because it will allow you to stay focused on the long term. And then make a plan, meaning create a portfolio that fits your requirements to get there. And in this video, I hope to give you an inspiration by looking at what is my personal portfolio strategies for my time horizon, which is forever. Afterwards, stick to the plan. Don't get distracted by ups and downs on the market, news cycles, and whatever else. Visualize your goals and stick to the plan. There are a lot of strategies out there for building a portfolio, and the truth is that there is not a best one as such, but there will be one that is best for you and your goals. So your role is to figure out what that is. I will share, of course, what works for me, but you have to remember that is just my perspective for my situation. The eternal dilemma of portfolio building is to how much being diversified. Because on one hand, we don't want to put all the eggs in one basket, but on the other hand, we also don't want to dilute our best ideas with a million stocks. So it's really an art to find the right balance. Some people swear that it's important to build a portfolio around market cap, with some big caps company, medium caps, and low cap stocks. I think this is a bad idea. How good or risky a business is has nothing to do with its size. Regarding this point, Warren Buffett has recently pointed out that if we compare the 20 biggest companies by market cap from today, which are on the right table, with the ones from 30 years ago on the left table, not even one survived. It's crazy. So think about building your retirement portfolio on the biggest stocks and assuming that that is a safe bet. And then 30 years from then, none of them is in the leading position. Not really smart. Another possibility for building the portfolio is splitting your holding based on geographies. For example, a certain percentage belonging to the US, another percentage to emerging markets, and then maybe Europe or Japan. I do understand the rationale, and I think there is some merit. For example, if there is political tensions in one region. However, we are missing the main point about portfolio building, which is collecting wonderful businesses. It doesn't matter where they are, what really matters is their prospects and the fact that their business is wonderful. Then there is Ray Dalio, which advocates to split the portfolio positions based on risks for each sector. This is what he calls an all-weather portfolio. It works wonderfully for reducing volatility, but it doesn't maximize returns, which is what I want to achieve. And finally, my favorite approach to build a portfolio, which is to focus on the business itself, its prospects and its valuations, regardless of the market cap, regardless of the geographical locations. Just focus on the business itself. Based on this, my strategy focuses on collecting the best businesses I can find. And that is what you see here in blue in the left graph. 80% of the portfolio should be the best businesses I can find, which I call here best ideas. A small part of the portfolio I call hedges and are here in gray, meaning a fallback and uncorrelated investment as compared to the remaining 80%. This part of the portfolio serves as protection in case the economy collapses or some unforeseeable macro trends happen that hurts the 80%. And here is an example of how I would build it in practice. The 80% I would split it between 4 to 8 best ideas. Here I present it with 6. You don't want to have too many because you don't want to dilute your best ideas, but you also don't want to have too few because it increases the risks. I think that 4-8 is a reasonable number. And then you have the 20% hedges that I put here as a split between gold and cash, which are of course uncorrelated to the best ideas. And here is how my current portfolio actually looks like. My 6 areas of investments are at the moment are e-commerce, electric vehicles, cannabis stocks, travel stocks, digitalization stocks, and energy. And my hedges are precious metals and others, which includes cash. As you can notice, I'm not that close to my goals that I just showed you. I'm way too exposed to precious metals hedge now, which is 27.5% of my portfolio, whereas I would like it to be between 7 and 10%. And I'm also extremely underexposed to the travel sector, which I believe will do very good in the years to come. But that's fine because valuation matters. So, although I want to increase my exposure to the travel industry, I'm not going to do it if I cannot find individual businesses that are a bargain now. I'm going to wait because portfolio building is a slow and steady game. I'm prepared that it can take 10 years to adjust the portfolio to the exact numbers I have in my head. Every business that ends in my portfolio needs to have the right perspective and the right valuation. And if it takes 10 years to reach that entry level that I set to myself, then okay, I will wait for the 10 years. And in the meantime, I can build the positions in sectors that are undervalued at the moment. Getting it right is more important than getting it fast with a so-so result. Another point that I would like to make is that for each area that you identify, you don't have to have a single stock. And this is what my portfolio actually looks like right now. In the precious metal part, for example, I have 6 stocks, but in the e-commerce, I only have one. This is not my ideal portfolio, and with time, I certainly want to consolidate my bets on much fewer players. But once again, it should take years to get there. Let's focus on the end goal and don't rush to the finish line. Another point I would like to make is that I have a job, so I have a monthly stream of income that I can deploy every single month. I think this plays a huge factor because I don't need to sell position to rebalance. I can just add fresh money to the positions that I think deserve addition at a specific time. And this is a huge psychological help because it puts you in the mentality of always adding and adding and adding until you achieve your financial goal. You don't want to jump around in positions, time the market and gamble. You want to be in the mindset of always adding and growing the pile. Now that I showed you my portfolio strategy, I would like to share with you why I personally own 0 ETFs. I'm not against ETF, but they are not for me, and here is why. ETF represents a basket of something, being the market or an individual sector, and their goal is to achieve the average return of that category. Let's take an example, an ETF that represents the S&P 500, which will give the market returns of the US stock market, which has been historically been around 7.5% per year, inflation adjusted. Let's make an example where I pick the 6 best ideas I can find, and I put $1 in each of those ideas. The best of the bunch, we assume will do fantastically, and will return 10x the investment in 3 years. The next stock will also do very, very well and will 2x in 3 years. Pick number 3 and 4 instead will achieve average return of the stock market, which is 7.5%. Pick number 5 instead will go down 30%, and pick number 6, something terrible happens and the stock will go to 0. At the end of the 3 years, I will have made a cumulative $15.18, which is a great return with just $6 invested. It's more doubling the money. If I put instead those $6 in a market ETF, I will have only $7.45, which is just half as much money as the first scenario. Obviously, you are never guaranteed to many x your money, but I truly believe that if you look at a lot of businesses and you pick the absolutely best you can find, you can get this type of returns. And in a course of a lifetime, these differences in returns will mean everything. So, how would you then pick those few stocks? Ideally, you would follow the approach on the left. You would go one stock by one and you would analyze the businesses of the entire stock market. This would be a totally unbiased, bottom up approach. However, it's a very inefficient way to approach it because you will analyze a ton of businesses that are nowhere close to an area with tailwinds and that you would understand. A more pragmatic and efficient way is to use a funnel approach, where you use some criteria to diminish the number of stocks to analyze and then dig deep only the businesses that fit those criteria. For me, there are only some market and businesses areas that I understand at a deep level, so I would naturally only want to focus on them. So that's the first part of the funnel. Next, I'm primarily interested in businesses that have good growth perspective and that have the potential to increase their market share. Strong tailwinds, proven growth record, and growth perspective is my second checkpoint to narrow down the potential stocks I buy. When these criteria are met, then I look at whether the business has a moat, good financial, and good management. To put all these in a step by step guide to build a portfolio, step number one would be to identify the 4 to 8 areas of investment that you believe will become more and more relevant in the years to come and that you understand well. Some examples are electric vehicle, aging population with all the more drugs, medical devices, etc. that have to be made, traveling sector, renewable energy, virtual reality, gaming, and many, many more. Step number two is to dive into how the business operates and identify the drivers and risks. The key here is to stick to what you understand well. For example, cosmetics I think is a very attractive investment possibility. However, I don't know anything about it. I can't go into a supermarket and look or try different brands and appreciate the differences between one brand and the other. And at the same time, pinpoint if a brand is undervalued or has the best quality price. Who's able to do that has an edge and can look closer to investment possibilities. But I can't. Instead, e commerce is something I understand. I use it. I know why sometimes I buy something online instead of going to a shop. So I appreciate the business itself. And this gives me the confidence to envision that more and more people will use it in the years to come, and consequently to invest in it. So, if I dig in the e commerce space and I find a great business like I found Alibaba, it doesn't matter if it crashes 50% the day after for some unforeseeable circumstances, because my understanding of the business and the market will give me the confidence to hold on it and weather the storm. Step number three, put it on the watch list and set the buy targets. Even if you found a great business, you don't need to hurry in. Building the portfolio is a long term game. So set the price targets that you believe are realistic and a bargain and wait until it gets there. And no need to go all in at one price. Better to scale in buys at different levels. Don't get too greedy though. If you found a great business and it is at a fair price, do get in. It can always go lower, but it doesn't matter. If it is a great business, it will come back up. In conclusion, there is not a magic formula to build a portfolio because everybody has a different financial goal and therefore there is a different perfect portfolio for different people. You need to find out what is the right for you. Once you found it, you are half the way to your financial goal. Stick to the plan until the goal is achieved. Be prepared for it to be a long ride though. Give yourself rules, for the businesses you buy. Don't bend the rules and obey them no matter what. Don't get greedy with entry if the business is great, and layer your buys. Then hold until the thesis play out. You must have a clear investment thesis for each stock you buy. Finally, the whole point about building wealth is accumulating fantastic businesses and assets little by little. So the mindset should always be on the buy side and adding to the portfolio. Every here and there will be some selling action, but that should happen rarely. The game is not trading and jumping from one stock to the other. The game is add little by little and watch your investment flourish. And yes, enjoy every piece of it. That's it for today. I hope you got a ton of value out of this video. If you liked it, please give it the thumbs up and consider subscribing for more videos. Have a great day.